Good morning everyone and welcome to Morning Markets here at True Potential. Now you'll see on screens that we had another strong day for equity markets. Yesterday, recovering some of the losses through the end of last week and the start of this week. Equity markets are continuing to focus on what is a strong US economy and strong employment economies across developed markets. And we have the continuation of this push and pull between strong economic data and expectations for interest rates still evolving. Now, central banks are unable to look through the strong data at the moment, and for now, even as inflation begins to fall particularly sharply in the US, but will broaden out into the UK later in the spring, we should expect some more rate cuts from all major economies as we head into the spring. Now, as colleagues have spoken with you over the last few days, the US jobs data for the month of January was particularly strong. Even with revisions to the sample of employment, we saw unusually high print for US jobs through January. Now, US Federal Reserve Chairman Powell was challenged on this directly yesterday during a scheduled Q&A. If they had known about this strong jobs print ahead of time before their monetary policy meeting on Wednesday last week, would they have hiked by only 25 basis points? The answer was probably yes. They were surprised by the number, but they would continue on this path of a lower projection of interest rate hikes into the spring. So we should expect further hikes at the next meeting in March and possibly into the later spring as we pass into the second quarter. However, markets were already expecting this following the jobs print on Friday, and they've been well set for a much lower path of interest rate hikes and a likely end as we get well into the spring. And that should take interest rates in the US to around about 5% and maybe a little bit above. And we're not far from there now anyway. So it's really a case of inflation doing the hard work in the US and continuing to decline substantially. And that's what we should expect even through February. There are substantial base effects, particularly in the US for Q1 this year. We could see inflation decline by over 1 percentage point just in this quarter as these base effects from last year's energy prices fall out and these much lower prints feed in to the inflation impulse in the US. And of course, what happens in the US typically follows through into the UK economy some months later, and we can expect substantial declines in UK inflation as we get through April and into the later spring. And that's really as a result of the way that we administer energy prices here in the UK. And for more detail on that, please do refer to our podcast from last week, where the investment team really focused on UK and US inflation and helped explain our outlook for inflation and central bank interest rates over the next few months. But particularly for the UK, we've had governors come out to condition the message following the Bank of England meeting last week to really just set the scene for further interest rate hikes into the end of this quarter and possibly at the start of next quarter. But it's going to be very difficult for the bank to continue to hike interest rates given the substantial declines in inflation which are building and are likely to come through, as I said, in Q2. So Catherine Mann, an external member of the voting committee at the Bank of England, would like to see a wholesale decline in all measures of inflation, particularly in wages. And of course, wages in the UK are still rising. So it might be that some members of the voting committee dissent come Q2, and rather than go with the majority of the committee on keeping rates on hold at around 4%, some of these external members may dissent and actually vote for a hike. They're unlikely to be successful, but it does show that one of the more split committees is the Bank of England Monetary Policy Committee. We already have 2 members who for the last 2 meetings have voted for no increases in interest rates. So interest rates have been increased materially, and 2 members have actually given their vote for interest rates being held around about 3%. We're at 4% now. So these dissents are likely to continue as these members see the inflation path differently from one another. It's nothing to be worried about, but it does show that the inflation volatility which dominated last year is likely to still feed into the way that some economists think about the market this year. Now, something we should note is that central banks so far are unwilling to accept that these economies are strong and are still recovering from the effects of COVID. The last of these is obviously the energy price shock, particularly in Europe. So once this feeds out and comes out of the inflation numbers, we should expect a much more sanguine outlook for inflation from the central banks. So that's all for today. Please join us tomorrow, where colleagues will update you on data in Europe and the US. Thank you very much.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.